All right, everyone. Thank you so much for joining, and welcome to the 12 Points and Lee and Crowley version of the March webinar. This month, we're going to be tackling an important topic as we get closer to our tax filing deadline, and that is strategies to reduce your contribution to Uncle Sam. However you feel about taxes, it's always good practice to make sure that you're using everything at your disposal to make sure that you're minimizing those. So we're going to talk about a bunch of strategies today. And hear from a guest speaker as well to offer his expertise as we go through tax filing season. So again, thank you so much for joining. My name is Dan Sharkey, and I'll be your host for this month's webinar. There's my ugly mug. I'm a senior relationship manager and a CFP here at 12 Points. But more importantly, I really want to thank and introduce Chris Lee, who is a CPA and a managing partner at Lee and Crowley here in Boston. Chris is an excellent friend of the firm. He works with several of our clients and is a true expert in public accounting. He advises businesses and individuals alike, and is really a trusted voice in this space. So Chris is going to lend his expertise here today, and he'll be able to answer any questions that you may have. And as we go through each slide, we'll talk about the various topics. Chris will give us his insight as he prepares for another tax season, and he was kind enough to take some time out of his day during his busiest time of the year. So we're really, really thankful for that. So Chris, thank you so much for joining. We really appreciate it.
Thanks, Dan. Yeah, that was a good intro. I don't know if I can add much more, but appreciate it.
Oh no, absolutely. We know you're busy, so we'll try to keep this to a half hour. But this is a really important topic, not only to our current clients, but for anyone else who's listening, because there are a lot of strategies that we really can utilize to lower our taxes. So your expertise is really welcome. And I'll kind of kick it off with this, and we'll get into various topics. And if anyone has any questions, please feel free to put them in the chat box, and we'll try to address those at the end. Each of these slides covers a variety of topics, so we'll try to get to everything that we can in a half an hour and get everyone back on to their workday. So Chris, just to start kind of with the low-hanging fruit. People generally who are on this call are W-2 employees. They go through payroll deductions. But from a tax perspective, what is the easiest way, and how do employer benefits really impact your personal taxes? And we'll start with the obvious one, which is your 401k, which most people have. How do your contributions to your 401k plan impact your tax return?
Sure. And so the easiest piece to save on taxes is to put money away and defer that income into the future, which is retirement savings through 401k plans is probably 90% of employers in America. Mm-hmm. And so for 2020 and for 21, anyone under the age of 50 can put $19,500 away annually tax-free. And so you make $100,000, you can put $19,500 of that into a retirement plan, and now you're only paying tax on $80,500. And then if you're over the age of 50, there's also $6,500 catch-up contributions, which allow you to put more money away for retirement as you, in theory, get closer to that retirement age.
And the one common question that we always get is a lot of employees assume that their company's contribution to their particular account within the 401k plan counts against that cap. Can you explain how that's actually the employee contribution limit, regardless of what the employer contributes?
Correct. And so that's just the portion that you as the employee contribute to the plan. Many plans have profit sharing provisions or safe harbor provisions that allow for your employer to put more money into the plan on your behalf, and then the employer picks up a deduction for that income or that expense into the plan. And so a lot of times the planning too, when we have business owners, is what's the best plan for them in order to put the maximum amount of money away between them and their business, and align the business goals and deductions with their retirement plans.
Yeah. And that's a really, really key point, because we have that conversation often, and I'm sure you do as well, as people trying to calculate, well, my employer put in this much, and so that means I can only put in this much. And the key takeaway that I want everyone to know is that is your personal limit. So the only thing that you need to worry about is if you're under the age of 50, you can calculate that 19.5 divided by however many pay periods you have. But that's a really key point. So thank you for clarifying that. A couple of the other areas that I have highlighted here: health savings account, flexible spending account. Can you just talk through a couple of those and how those ultimately, filter down to your tax return?
Sure. And so the health savings account and the flexible spending account both are similar but different at the same time, and they're surrounding what deductions or pre-tax money you can put away for expenses that go along with medical care. And so there are the two plans, and the major difference is it's a use it or lose it provision, really. And so the FSAs are part of a benefits package from your employer. You can't just go open one on your own, but it's a use it or lose it. So whatever money you put into that FSA, you have to use during the year, or it gets remitted back to your employer. However, the CARES Act for 2020 allowed for the first time in 30 years that employees could roll $500 over into 2021 because of the lack of expenses in 2020, because nobody really left the house for an extended period of time.
Right. 2020 is a year for a lot of these things, isn't it? It's unbelievable.
Yeah, exactly. And then the HSA, the health savings account, is more of a tax planning and almost an investment planning vehicle, in that they are available only to people with high deductible health plans. So you have to talk to your benefit broker to figure out if that works. However, when you put money into an HSA, many plans allow you to invest that money pre-tax. So you put money in pre-tax, same way as a 401k. You can invest that money. It grows tax-free, and then over time you can take those deductions out for qualifying medical expenses without ever paying tax on that money.
And what's really interesting about an HSA is that the ability for this money to grow over time. Can you actually talk through as well? I believe, and please correct me if I'm wrong, when you reach age 65, you can even withdraw that money for non-medical expenses as well, correct?
So that's when you hit and qualify for Medicare.
Mm-hmm.
And there are different rules as you get out, longer in age, but yeah, you can basically use that money as a, partially a de facto, deferral of income to, when you get on into retirement age.
Yeah, no, it's a really powerful strategy, especially if you're, an employee who's a higher runner who can utilize this and has a high deductible plan. So that's really good to know. One other comment that I'd also make on the FSA, there's a great benefit if it's available through your employer for childcare as well. So I, just speaking personally, I have an FSA to cover daycare costs. So for $5,000 pre-tax, I'm able to cover a portion of my daycare expenses for my two kids. And it's really highlights how it's important to understand what these accounts are utilized for, and to really scrutinize what your employer is offering, because there are really some enticing benefits that are available. The one key provision that and Chris already mentioned it, but just to reiterate, for an FSA though, it is use it or lose it. So make sure that you utilize all the funds in that account in that particular tax year. Otherwise, they'll be gifted away, which we never want to see happen. So that's an important thing. One other point to note, and Chris, you can touch on this briefly, is if you change jobs, be mindful of your withholding elections too, because we know that's going to be a key determinant in what your take-home pay will be, correct?
Correct, yeah. And so when you change jobs, especially mid-year or towards the end of the year, if your withholding allowances are not properly elected, and we don't take into account that, you may have already earned $100,000 at job one, and the first dollar you earn at job two is really your 101,000th dollar of income, that's taxed at a different rate than your first dollar. So we need to be mindful that that's at a higher rate, and we need to make sure that you're remitting payroll taxes properly, because we get it all the time of people that, they thought they were going to get a refund, they weren't going to owe money, and then because they changed jobs and they withheld at a lower amount, they ended up getting a surprise tax bill come April 15th.
It's really important to know, and then the timing of all these things is critical. So just just one key reminder: if you do change jobs or if you do elect some employer benefits, really make sure you understand what you're signing up for, so you don't get yourself in the crosshairs inadvertently. Okay, moving on to another area that I think we've seen a lot of, given the year that we had in 2020, whether it's the support of small businesses or other charitable endeavors that may be impacting your direct community. But charitable donations are always a key question that people have and how they can actually capitalize on them. Due to the recent Tax and Jobs Act that was passed in 2017, there have been some changes, so we'll go over those briefly. But we just want to generally talk about what options people have. So starting first here with a donor advised fund. So how does a donor advised fund impact, what exactly is that and how does that impact someone for their charitable giving?
Yeah, and so the donor advised funds allow for people to make a gift, a taxable donation to a fund that they basically get to continue to direct how or what they want to do with the money. And so really what we were kind of talking about with this charitable donations page is that you want to be mindful of grouping deductions together in years that you would or would not get the benefit for the charitable donation. So because of the Tax Cuts and Jobs Act that you discussed, the standard deduction for married filing jointly is now $24,000. So it became much more difficult for clients who make charitable giving as part of their tax planning strategy to actually get over that $24,000 threshold.
Right.
And so by taking into account, what options we have to increase our, charitable giving in a certain year in order to get the full benefit versus, if we make 5 $1,000 contributions every year, can we do, a $5,000 contribution in 1 year to a donor advised fund in order to get the tax deduction for those donations, but also, still continue to meet your charitable giving goals as part of your financial plan.
Yeah, and that's a really important point to note. And where we see this manifest itself a lot with clients is when they have an event in a given year in which their income is disproportionately higher than any other years, whether they sell a business, whether they have another liquidity event that causes income to skyrocket. You can, to your point, you can really accelerate your giving in that particular year to take advantage of that extra capacity. So it's a really great strategy that allows you to capture your deduction in 1 year. And then a key point that I want to remind the audience is that you don't have to give away all that money in that exact year. You're simply you're providing those assets to a fund, which you can then distribute over time to the causes that you care about. So it's a really unique way to do some advanced tax planning, and it's a really great way to help the causes that you care about. So for those who are charitably inclined, it is certainly a great option to consider. And obviously, with the impact of the rise in the standard deduction, it's really made the smaller deductions harder for people to take advantage of tax-wise. And we all know that the smaller deductions are kind of in a lot of cases the lifeblood of some smaller organizations. So it can present some challenges. Talk a little bit about the difference between if I were to donate securities versus cash. Is the tax treatment of those two assets different?
It is, yeah. So when you donate cash, it's a 1-for-1 deduction. You give $1 to a charity, you get a $1 deduction against your taxable income for the year, assuming you itemize. But when people have, and we see this a lot, when you have either a concentrated stock position in a company that you've worked for a long, long time, and you've had stock options, you've had vested units, you name it. A lot of people have these exorbitant gains that they really can't justify selling because of the tax burden of that sale. And so when you donate securities, you are allowed to take a deduction for the fair market value of those securities. However, you don't have to pay in a lot of cases, there are certain circumstances, but you don't have to pay the capital gains tax on your built-in gains. So, if you bought a stock for $100 25 years ago and it's worth $10,000, instead of paying that $9,900 of capital gain or tax on that $9,900, you get a $10,000 deduction for donating that stock. And so it saves you in the capital gains tax and income tax, but it also allows you for a $10,000 deduction against your income in that given year.
And this is why that example alone highlights why proper tax planning is so imperative. Because in that example, not only are you getting the benefit of the value of the security, but you're also avoiding the tax implication, which is, in my mind, an additional benefit and a key benefit as to why you would utilize this type of strategy. So it's important to look at it if you're someone who is charitably inclined, to look out over your ecosystem of all the assets that you could potentially give, and then ensure that you talk to an advisor or a CPA like Chris and his firm to really give you the best guidance on how you can make those charitable intentions a reality. It's not just as everyone kind of thinks grandma throwing the money in the church basket, but there's a lot more ways to attack your charitable giving, and you could really benefit not only personally from the avoidance of having to pay taxes, but also impact the organization that you're choosing to support in ways that may not have been previously known. So that's a really key point. And this kind of ties into the last point here about the qualified charitable distribution. Can you talk a little bit about what a QCD is and how it might be beneficial for charity?
Yeah, so the QCDs come out of IRAs for people who are 70 and a half or older, and they go directly to a qualified charity up to $100,000, which allows for people to take the deduction for money that they would have to take out if they were an RMD or something out of their IRA. Mm-hmm. And so one of the biggest provisions, I think, as part of this, so that qualified charitable distribution has been around for a while, but what they did was the CARES Act that was passed, just about a year ago, allowed for 100% deduction against income in 2020, and I believe they've extended it for 2021. We're still trying to get through last filing season, but they have allowed for 100% deduction against income for certain charitable endeavors. So whereas before there have been limitations around your total charitable giving on a tax return, we now have a lot more flexibility in terms of it. It used to be 60% and it's now up to 100. So if your adjusted gross income is $100,000 per year, you can now give away $100,000 when in 2019 you may have been limited to $60,000. So a lot of these qualified charitable distributions now have to be factored into that overall plan because our total limits are different. So what the tax and tax strategy and financial plan were, even last year, 2019 versus 2020, things have changed drastically. So when you may have felt like you had a really good strategy going forward, it might be time to take a look under the hood and see if, maybe coupling, different deductions or different donations along with these qualified charitable distributions may make sense in certain scenarios.
Yeah, no, and it's a great point. It's something for everyone to keep in mind. As you get more complex, and to be perfectly frank, you don't have to have an overly complex tax return to benefit from working with a firm like Chris's, for example. The tax law changes so rapidly and is so complex that there are a lot of times considerations that you're not fully taking advantage of. So it's always important to just talk to a professional before you go ahead and develop a plan that may not be as efficient as it could be. So that's a great point. Life events, getting married, getting divorced, children, buying a home. Can you just talk through how some of these events impact your return, specifically change in filing status, let's say from filing as a single member of a household to filing jointly, or the addition of a child may impact your overall return?
Sure. So for the biggest question I think we get from young couples that have gotten married over the years, even if you get married on December 31st, you're considered to be married filing jointly for the whole year. So those type of, calculations as you're going through the year, if you're assuming you're going to be a single filer, it's important to take into account that whatever happens during that year, even if it's on the last day of the year, will impact the other 364 days a year. So similarly with a child, if the child was born, we had a couple of clients who really good tax planning. They snuck their kids in, between the last week of December, and they got $2,000 as a child tax credit. So those things, and that child tax credit is a hot topic in Washington D.C. right now. That they're looking, the IRS is looking at making payments monthly, depending on income, and increasing those dependent care benefits for qualifying children. So one of those things to really keep in mind, that not only is your family life changing, but your tax situation is going to change drastically. And so the same point originally with the withholdings, that if you're a single taxpayer, zero withholdings, and now all of a sudden you're married filing jointly, and sometimes the spouses have drastically different incomes. If your spouse has higher income than you do, then you actually may end up paying more tax. And if your spouse has less income than you do, then you may actually pay less in tax filing together. So it's one of those things that we have to look at it on a case by case basis. But pretty much in all scenarios, when you get married, when you have a kid, and when you buy the house, it's changing, and we need to take into account those changes to make sure that there aren't surprises when the returns end up getting prepared April 15th of the following year.
Yeah, and it's important to know, and no one is suggesting that you get married or don't get married for tax purposes, but there are considerations that you should at least be mindful of, like you said, so there's no surprises there. Having eyes wide open as you go in and seeing how your financial situation may change is always an important point to know, especially for how different couples may treat their home finances, that you end up maybe paying more as an individual due to your spouse or partner's earning power. So it's always just something to keep in mind, though perhaps not a determining factor.
I think one of the other things too is life events is really transitioning assets among family members from parents to kids and to grandkids. We've seen, as everyone knows right now, with all the different refinances, interest rates are at lows that a lot of us haven't seen before. And when you gift or when you lend money between individuals, there's something called an applicable federal rate, an AFR, and those rates are extremely low right now. So what we've been doing from a strategy for some of our higher net worth clients to move money around is basically you can lend money to other family members, and you can in some cases pay 1% on that money, which is really unheard of. That you can transfer money among family members for really next to nothing from an interest rate perspective. So those type of things, it's holistic, right? It's you want to make sure that you're not just looking in one silo. You want to look at the whole picture, moving money from parents that are getting up to this federal estate exemption, which may or may not come down, moving among states. A lot of people have had jobs that have gone fully remote and are relocating. And so another thing to keep in mind is what individual estate taxes look like. If you're, retiring and you're looking at moving, how does that affect your estate plan? How does that affect your tax plan on what, assets may or may not need to be sold in order to pay those estate taxes?
So that point you just made raises two excellent one, and I want to follow up with two questions that I think would be helpful and applicable. So talk a little bit about why wealthier families would consider, and quite frankly, even those who aren't would themselves consider themselves overly wealthy, but why would they want to consider interfamily loans as opposed to straight up gifting? Right? Can you talk a little bit about the annual gifting exclusion and the limits that are imposed, and why interfamily loans are so valuable?
Sure. And so the main point of the whole thing is that there's a federal and there are state estate exemptions, meaning anything under a certain dollar amount is tax free when someone dies, and then anything over that there are taxes due as of date of death. And so annually you can gift money, $15,000 a year, and that's all well and good. You're a very nice person, and there's really no paper trail that goes along with that. If You go above that, you eat into that lifetime exemption. And so people that have, a lot of money changing hands, they have a big family, you want to give money to someone to buy a house to your kid or to the grandkids. We have to keep all of those things in mind, that if you give more than that $15,000, it's going to eat into what you get to not pay tax on when you die. And so interfamily lending allows for money to change hands, again, at those really low applicable federal rates, and it doesn't eat into that exclusion lifetime or annual $15,000. So it can be a powerful tool to use when you already are giving away the $15,000. You already are using things like QPERTs. You already are using other type of trust vehicles. It's just another tool in the toolbox that we can use to help mitigate the overall burden of that estate tax.
Yeah, and it's a great tactic. It really is something that families can utilize to secure the futures of future generations. And the other thing to note too, just from a mechanical perspective, if you do decide to utilize this strategy, it's important to always ensure that you're documenting things properly, that those interest payments, while they're low, are still made, and that everything is being properly recorded, because it's a loan like any other. Just because it's between family members doesn't mean that you can be slack on the bookkeeping part of it. So for those who do utilize that strategy, just ensure that you properly document everything that's going on, because that's really important. And the other question that came to mind, that as you were just describing 2020 and the kind of weird year that we've had, is a lot of people working remotely and those who have to cross state lines. Does that impact their state filing if they, let's say they live in Rhode Island and work in Massachusetts, for example? How should people consider, and how should they think about what state they have to file in if they've worked fully remote from a state that's different from where their general employer was?
It's a loaded question. Well, right now, there's a
and let
lawsuit.
Me clarify too. Everyone should speak to their own tax preparer as it impacts their personal situation, but it is a question that we've seen raised in a couple of areas.
Oh, we've gotten it, hundreds of times. Even on the business side of things, we have businesses asking, well, now we have Dan working remotely from New Jersey at his parents' house. Mm-hmm. Are we subject to New Jersey income tax, New Jersey sales tax? We've looked at all of those things, and it's very nuanced. New Jersey, historically, if you had one person working there as a business, you were subject to sales tax rules. And so above and beyond just personal taxes, it's a holistic look at things. But there's a lot of moving pieces, and it's tough to give you an answer on that. Massachusetts earlier in 2020 came out and said, if you are in the state of New Hampshire working at the same job, even though you're remote and you haven't stepped foot in the state of Massachusetts, if you're doing the same job as you were before, Massachusetts is still considering you to be your income to be taxable in Massachusetts to that employer. New Hampshire came out and said, no way. Our citizens or our residents are, they're not going to pay income tax. That's not possible. And I believe, they basically said, we'll see you in court. And that's yet to play out. I think there's a lot of different things. Some states, it was like 16 states last time I looked, had given some guidance. Others are silent. Others are more ambiguous. So it really is going to come down to a state by state, case by case basis. But exactly as you said, you may have surprise allocation of income. I know we have more than a few clients that were in New York City. They ran out of the city to South Florida and thought they were going to be, tax-free living. And all of a sudden they got their W-2 and all of their income was still coded as New York City. So those things are really important to keep in mind. Just because you moved, if you work for a big employer, your employer may not know that you're not in the city or you're not working from where they thought you were. So it's really important to kind of make sure you have your, T's crossed and your I's dotted as you go through relocating and looking at different states.
Yeah, no, it's a great point to consider, and it's also something that no assumptions should be made. This just highlights how complicated tax law can be, especially reciprocal tax law between states. Always make sure you're on solid footing before you make any assumptions. Okay, so talking a little bit about your investment portfolio. What are some things that you can do to kind of offset your capital gains? And specifically, we have here tax loss harvesting. If you could kind of talk through what that is.
Sure. And so this is really where having an advisor and having a team around you is going to come into play, because, the guy day trading on Robinhood is not going to be a tax loss harvesting expert. But basically what we want to look at is how did your portfolio do last year? Did you have $50 million in gains from GameStop? Did you invest in, some other stock that went to zero? I don't think GameStop's gone to zero yet, but who knows? And it's really looking at, do you have gains and then do you have losses? And so the main point in a question we get often is, even though you bought a stock at 10 and it's worth 100, you don't pay tax on that until you actually sell it and recognize the gain for 100. So the big point is, we want to look at what do we have in the portfolio that has been sold and we actually do have to pay tax on for gains. And then what do we have in the portfolio that has a loss and we may not have sold it and we could sell it in order to offset other gains. So it's really aligning your portfolio with, your tax strategy, meaning if you have a couple of investments that went south and you don't think they're going to come back up and you want to save on taxes on the investments that actually went up, you can sell those losses and recognize the loss and offset the gains that you had during the year.
Yeah,
and I think the main point is really you have to sell these stocks to recognize that. Just because you put 10,000 in and it's worth $1 doesn't mean you get that deduction until you actually sell it.
Yeah, no, that's really important. It kind of leads to the next topic, which is a far more obscure, tax provision, but a wash sale rule. Can you talk how that may impact the ability for you when you're buying and selling stocks at any type of frequency?
Yeah, so if you're trading or you're trying to, again, tax loss harvest, there's a provision called a wash sale loss, which was basically designed to discourage people from selling securities at a loss just to claim the tax benefit. So if you have Apple stock that you have a loss on and you sell it today, you have to wait 30 days before you can rebuy the same stock, meaning you can't sell it today, take the loss, and then rebuy it tomorrow, and then let it go back up just so you can have the tax deduction. So that's one big provision that a lot of our clients have gotten tripped up on if they haven't asked or they weren't aware of it, is just because you sold the stock doesn't necessarily mean that you are going to get the loss if you immediately then went back and rebought the same stock or substantially identical securities.
Yeah, and that's really important, because you can undo all the intentions of that trade just by not paying attention to the date. So that's always a key provision for everyone to keep in mind. Speaking of thinking about holding period and being mindful of dates, can you talk about the difference between short-term and long-term capital gains and what the differences between those two are?
Sure. So long-term capital gain rates are any stock that was bought and held for 366 days, a year and a day, meaning you held it for longer than 1 year. And at least up until today, there are advantageous rates, for the highest being 20% on long-term capital gain rates. There's an additional 3.8% Medicare surcharge that brings the rate up just south of 24%. But compared to short-term capital gains, which are taxed at your ordinary income rate, so up to 37, 39%, depending on how some of these tax provisions go through. So in one case right there, use 37 versus 24%, you can save 13% by holding it for, a year and a day. And so really important, again, to look at what you have in the portfolio. And if you do have a gain, can you ride it out for another few days if that's going to get you over the long-term capital gain rate in order to then mitigate what your actual tax payment is going to be on that same gain, because the difference can be 13% based on, 24 hours.
Yeah, and that's really important, because the capital gains rates are so much more favorable than ordinary income. So anytime you're making portfolio decisions, you have to be mindful of what the tax implications are. It's a key component of ensuring proper portfolio management. So make sure you talk to your accountant or advisor as you're executing some of these things on your own. And then, so this is the last slide we'll come to, but what are some other ways that, and other strategies that offer, beneficial tax treatment, whether it be a traditional IRA, Roth IRA? Could you talk a little bit about some of the stipulations around contributing to a traditional IRA, for example, and how that might benefit you from a tax perspective under certain circumstances?
Yep. And so all of these things, the traditional, the Roth, or at least those two, have income limitations on them. So what you can deduct and get a deduction against income for, what actually for a Roth, if you make too much money, you're considered to be ineligible for a Roth. And there are strategies like a backdoor Roth conversion, which involves a contribution to a traditional IRA and a rollover into the Roth IRA. And so those things, it's again part of the overall financial picture that if your advisor thinks you should have more money in a traditional or more money in a Roth, we need to look at what contributions are being made into those accounts in order to really balance and align our goals long term with, as we know, the traditional IRA. When you take the money out, it's taxable to you. When you take money out of a Roth IRA, it's not taxable. So the rule of thumb, at least in the tax world, is if you're putting money into a Roth IRA, do you think your tax rates are going to be higher when you take it out or higher when you put it in? And if you think it's going to be higher when you take it out, then you pay the tax now. You put the money into the Roth, you let that grow tax-free, and you can take that money out when you need it down the road. And then I think, the SEP, go ahead.
No, go ahead. Sorry.
And then the SEP IRA and the 401k, those really come into play when we have business owners, even be it, Schedule Cs that are just doing some consulting, or, up to S corporations that they have employees, they've got operations in multiple states. A lot of our time that's spent with those business owners is saying, okay, here's your income, here's your, your net income. And then here are the options for putting money away tax-free. We can look at a SEP IRA. We can, $56,000, $7,000. A lot of times we look at cash balance plans, $200,000, $300,000, $400,000 we can put into those tax-free, which again is, a far more complex planning structure than we're looking at here. But I think the crux of it is every situation is different, and there's going to be nuances to each one with what the most beneficial plan for you as the taxpayer is. And so it's really important to take the time to consider all of these things, because what, is good for me may not be good for you. And what's good for you may not be good for your brother, and what you consider to be very similar situations. So it's really looking into each individual situation to make sure that what your strategy and what your tax planning and your financial planning are all aligned, and those advisors are all talking to each other, which I think is probably the most important part.
Yeah, and it just speaks to the individuality of everyone's tax circumstances. Very much like, designing a portfolio that's good for you and your family does not necessarily mean that that's the same for your next door neighbor. So always be mindful that tax preparation and tax planning specifically are really an individual activity. So it's always important to really think about it in the context of your own personal situation, not anyone else. That's a great point. Okay, so we're going to just have a couple questions here. So the first one came in through writing, through email, and I just touch it first. So the IRS just extended the tax filing deadline, but some states haven't extended the deadline themselves, or the quarterly payments are still due in April. So can you talk about the difference between, still needing to make a quarterly payment and the change in the exact filing deadline, and what the differences between those two are?
The filing deadline change was a hot topic, I think, among the CPA, world that we get our emails from every day. And it was pretty much 50-50, being a lot of advisors don't want to extend, and then 50% of them said, there's no way we can get all this work done with working remotely, et cetera. And so the main reason, from my understanding, for the extension was the processing of the stimulus payments, that the IRS just doesn't have the capacity in order to process the stimulus payments and process tax returns. And so what ended up happening, though, is some states, they rely on the cash flow on April 15th from all of these returns being filed. And so they really didn't want to push the deadline out. And so the extension of the filing deadline, exactly as you said, is just for 2020. The 2021 quarterly estimates are still due April 15th. And a lot of times we have clients that for their extension payment, we basically roll that first quarter payment into it. So now we've got a first quarter payment that's due April 15th, but extension payment's not due till May 17th. How do we align those two things? And I think that that's going to play out over the next few weeks because it's a question that we don't really have a good answer to. So for 2021, we still need to stay on schedule, but the year prior, we're now, a month later. So it really is, again, going to be, if you have the capacity and you have the time and you have the information, don't wait until May 17th. If you don't want to pay until then, great. But, and from an advisor's perspective, we don't want to work another month just as much as, nobody else wants to work another month of tax season. So if we can get everything filed by April 15th, perfect. But, you just don't have to cut the check until May 17th. But it's really the being expeditious with your filings, with, staying on top of your tax obligations makes everyone's lives a little bit easier.
No, that's great. And some more questions that came in through the chat box. Speaking of employer plans, what if you have multiple jobs or have a 403B? Can you contribute to both plans?
So you're saying a taxpayer that changed jobs or has two jobs?
Or no, someone that has multiple jobs, as the question was asked. So if you have, multiple jobs with access to multiple 401k plans.
So it's still the 19,500, I believe, and you can correct me if I'm wrong, but it's still the 19,500 is your total contribution during a year that you can't go over.
Okay. What about a question here from Robert? What about tax advantage investments or a backdoor IRA? Now, just quickly on the backdoor, Roth conversion, it is important to note that if you do convert IRA dollars to a Roth IRA, you have to do so proportionally. You can't pick and choose which assets to convert. So sometimes that's left out. So, Robert, if you could kind of just leave a little more clarity as to what you mean by that question, we'll kind of come back to it. Chris, another question here is, can you discuss working children changing status to non-dependents to take advantage of stimulus payments? Has that topic come up in any of your discussion with clients?
Yeah, it has. It has. Yep, a lot. Because many times their parents and them being a dependent, they're ineligible for the stimulus, and the kids are saying, well, I had earned income. And it's really, the test is, it's a dependent test, meaning do they provide 50% or more of their own support from earned income? So earned income is the main point there, especially for 2020. We've seen a lot of people collecting unemployment, meaning, that money came in, they could have supported themselves, but unemployment is not considered to be earned income, and neither is investment income. So if they have an investment portfolio and you may or may not be subject to the kiddie tax, all of those things come into play. And it really is, it's not necessarily, they're not a dependent anymore because we want to get the stimulus. They're not a dependent anymore because they provided 51% or more than 50% of their support from their earned income. So it's really an important thing to keep an eye out on. Just because you want to get an extra, $1,400 or what have you, you want to make sure that you're not tripping up over support expenses or support income, because that's really what will dictate whether or not they are a dependent for tax purposes.
Got it. That's helpful. And then the last one here is from Sanjay. In case I plan to leave the U.S. in 3 to 4 years being on a H-1B visa, does it make sense to invest in a 401k or an HSA? And I'll just touch on that first before if you have any thoughts, Chris, feel free to add them. It still reduces your taxable income, which is a huge benefit. I would just be mindful of thinking about, if you do leave the country, the difficulty in potentially taking those assets with you and what might be involved in that. So that's a little bit outside the scope of this conversation, but it's just something to be mindful of. So I didn't know if you had any thoughts on that question, Chris.
Yeah, I think you've articulated it well, but it'll come down to the plan docs of whether or not you can take the money with you, or how you get it out. If you're going to be subject to early withdrawal penalties, that would offset potential tax savings. Again, it's it's exactly what we said of looking at individual scenarios and making sure the plan is the best. There isn't really a yes or no answer, unfortunately, to that.
Yeah, agreed. So those are all our questions. If anyone else has anything, I'm going to show Chris here. We'll slide back. Please feel free to reach out to me. You can check Chris's firm at leeandcrowley.com. As I mentioned, he's an excellent professional, as everyone witnessed through this webinar, and a lot of our clients here at 12 Points utilize Lee and Crowley. So we're Chris, really thankful for your time. We know it's a busy time of year, so we really appreciate your expertise.
Appreciate you having me.
All right, thank you, everyone. Everyone will get a follow-up email with the webinar that's recorded. So I hope everyone has a wonderful day. Thank you so much.
Thanks again, Dan.